All right, yes. First of all, welcome to a finishing touch video on breakaway gaps. And we already went over breakaway gaps in the YouTube as well. If you haven't watched that, then I would highly advise to do watch that, because that is a very beneficial video on the YouTube and it will make a lot of sense to you as well after watching this video. Because there's also certain things that I did not mention in that YouTube video and that I will mention in this particular video. So the first thing that is important to understand is the type of breakaway gaps that we had. And we have a classic breakaway gap, we have a variation breakaway gap, and we have a fair value breakaway gap. Now, then the next thing that we need to understand before we go over those three breakaway gaps is there always needs to be some kind of draw liquidity. And the way I see that is you are always determining, you're always measuring if we are first going to reach for the draw liquidity, or we are first going to trade back into the fair value gap before we then go to the draw liquidity. That concludes the idea of a breakaway gap. Because if we define a breakaway gap is essentially a fair value gap, but the term breakaway gap means that it's a fair value gap that won't be traded back into. Where a fair value gap, you're expecting a retrace back into, you're expecting a move into. Where a breakaway gap is essentially a neglected fair value gap. So it's also not a PD rate that we would want to trade off of, which is very important to understand because that leads to overall different possibilities for us to actually take a trade instead and what we do instead. So the breakaway gap is when there's a lot of momentum in the market and the price first wants to reach a draw liquidity before then potentially coming back into that breakaway gap, in other words, that fair value gap. So how do we look at that? Well, first of all, we need context, like we mentioned, right? If we don't have a drawn liquidity, then all this won't make a lot of sense. So we have this monthly context sitting right there. We respected it, and then we can continue higher off of that, because then this becomes the drawn liquidity. Towards that drawn liquidity, and this is what you'll see a lot of times, right? This is all fractal. This is also something you will see in your entry patterns a lot of time. That is why I sometimes like to enter on the creation of the fair value gap, which we also went over in a different finishing touch video of this enrollment. So right here on the weekly, we can see different fair value gaps, which are actually breakaway gaps right there. Breakaway gaps because they did not get traded back into. And then the highest one we have sitting right there is indeed a fair value gap. Why is that? Well, can we notice slight differentiators between these fair value gaps? Well, I can notice one thing is that the first fair value gap being created, which is sitting right there, if we use the replay tool, this is the first fair value gap. And if we notice the 3 candle pattern that we always pay attention to in very much detail, right? We want to pay attention to it in a lot of detail because if we understand those basics, it becomes very almost simple, almost easy to understand what the next candle wants to do. So right here, if we have the 1, 2, 3, which creates the weekly fair value gap sitting right there. In this third candle, which is also a new expansion phase, we could argue. Why is that? Because it closes above the expansion phase, the second candle high right there. Since it closes above, price action at that moment in time is not really interested, is not making it simple for price to trade back into the fair value gap right there, the next candle. So this fourth candle, if it wanted to now trade back into the fair value gap to then continue higher, it would need to make a hefty retracement. This is why you'll hear me often say in the forecast as well, this is too much of a retracement to make before reaching the drawn liquidity. When I say that, I'm referring to a breakaway gap most of the time. So right here, to expect the next candle to do something like this, to then continue higher, is low probability. Again, low probability, right? Because we're always working with probabilities. That's what we need to understand, because sometimes these candles will still get traded back into. But the highest probability thing to happen right there is that we already continue higher. So what can we do? Well, since this is now classified as a breakaway gap, and it's classified as a breakaway gap by understanding that it closed above this expansion phase candle high. So the second candle high right there, closed above. So that is seen now as a breakaway gap. We would not expect this fair value gap to be traded back into before we actually reach the draw on liquidity right there in the form of those highs. So what can we do? Well, since we technically speaking have a breakaway gap, which is not a part of our PD matrix. So meaning we don't have context right there, right? We don't have context currently. So what can we do? We can go down a time frame to then find new context to continue higher off of instead. So this is where you are allowed to go into the daily, for example, where you have those daily fair value gaps and where you eventually have new daily fair value gaps and 4-hour fair value gaps as well to continue higher off of right there, where they don't need to be in context because we have a breakaway gap sitting right there. The same goes for this next one, because now we have this weekly fair value gap sitting right there. And that weekly fair value gap is again a breakaway gap, because simply the measurement, and this is what I like to do if we want to make it very logical, what do? We measure, all right, it would need to make around 1750 point retracement before it actually comes back into the fair value gap. All right, how far is the drawn liquidity then? The drawn liquidity right there is around 1400. So the drawn liquidity at that moment in time is closer than that fair value gap, which for the previous fair value gap, we could have argued this drawn liquidity right there in the form of those swing highs. So right there, do we need to make a retracement, or is a retracement right now logical if we know price wants to reach that drawn liquidity as fast as possible? This is also the reason why, and leads me back to a full circle moment where in previous enrollments we always mentioned high probability conditions happen extremely fast. And that is because, very simply said, why do moves happen during news events? Why do moves happen during NFP, during CPI, during FOMC, where it's very difficult to actually get involved due to brokers acting weird and opening up their spreads, etc. Why is that? Why in high probability conditions is price moving fast? Because they don't want you to be a part of that move. That is why it's a fast move. So right there, we want to take that drawn liquidity, we want to reach that opposite liquidity fast. And when we reach it fast right there, we are leaving behind breakaway gaps, fair value gaps that are not actual fair value gaps because they are breakaway gaps, which we are not trying to trade back into. So at that moment in time, we have another breakaway gap. So here, what do? Well, here we can again go into the daily time frame to see, all right, now we have this daily fair value gap, which we can then perfectly fine trade off of right there to then just have this normal context sitting right there. At that moment in time, and this is the, what is that called again? The no return theory, right? Where right there, if we sweep that high, we are creating right now a new weekly fair value gap. We are sweeping that previous week high right there. And now pay attention to this, because now we are closing below that second candle's high right there, meaning that this indeed is a fair value gap, which we can trade back into before we reach the drawn liquidity right there. Why is that? Again, this is the classic fair value gap variant right there. And we also have the normal fair value gap right there, which you would want to expect. These fair value gaps right there, when we are not closing above that second candle high, second candle high, meaning we're always referring to a 3 candle pattern, right? 1, 2, 3. Second candle high is always the expansion phase. So we are not closing above that expansion phase candle right there. And then we are setting up price to trade back easily into the fair value gap to then continue higher off of that as well. So let's delete those breakaway gaps. And then right there, this is where we are now expecting a retracement into that fair value gap, which is a valid discount rate again, to then look to continue higher off of that. And this is a classic breakaway gap and the fair value gap that we went over. Now, after we take a high, and now we are moving to a fair value breakaway gap right there. After we take a high, we have also talked about in this advanced enrollment about fair value areas, right? Where if we focus on that 3 swing movement, which is very simply said, and when you are focusing on fair value areas, you're always focusing on the most recent 3 swing movements. So that's very structural scene as well, where it's simply mitigation block, by the way, but 1, 2, 3, which creates a mitigation block right there, which could also create an order block at times. So right there, that is the area which is now already fair value. Because again, what is that fair value area? We have offered buy side, we have offered sell side. Buy side, very simply said, is just price moving higher. Sell side, very simply said, is just price moving lower, overall lower. Doesn't need to be every candle lower, just overall lower. Then eventually price is allowed to move higher with fair value gaps right there. When price is allowed to move higher, that is when we can confidently say that this area has now been offered fair value overall, which is the same premise of what we actually saw on this time frame where we have that high. It's the same premise, also fair value, to then eventually continue higher right there. So what we see is that this area is fair value, which means that if that area is fair value, there's no reason to come lower into that area. So once we have this high sitting right there, and we also have a fair value gap in the form of a weekly fair value gap sitting right there, then it becomes interesting. Because this fair value gap is an actual fair value gap, which is overlapping with the overall fair value area sitting right there as well, which we would now want to expect higher prices off of. Now, that leads us to also understanding that we have two different fair value gaps still sitting right there, which originally were breakaway gaps, classic breakaway gaps. Even if those were fair value gaps and they did not get traded back into before we reached the drawn liquidity right there, then at this moment in time, once we have this fair value area right there, these two lowest fair value gaps are still breakaway gaps, and we are not expecting a retracement back into those fair value gaps unless we have potentially a month fair value gap right there, which we can also see is also a breakaway gap right there. So this month fair value gap is also a breakaway gap. So what are we expecting? We are expecting a move higher already off of this weekly fair value gap to then continue higher off of that. So all this price action right here, all the fair value gaps sitting right there are all breakaway gaps, meaning they are not discount arrays that we want to trade off of, meaning we can neglect them. So the weekly not being in context of the monthly right there is not important because there's no monthly context to begin with because there's no fair value gap. But there is a breakaway gap, which is not a fair value gap, because a fair value gap, if it was a fair value gap, we would want to trade off of it. If it's a breakaway gap, we do not necessarily want to trade off of it. Hopefully that makes sense. So this is, and these are right there, these lower fair value gaps, or the breakaway gaps, are fair value breakaway gaps. And the reason they are fair value breakaway gaps is because we have that fair value box right there. So we would not expect a deep retracement. And if that does happen, then we are likely doing the other thing on how the market moves, because then we are likely reaching liquidity in the form of these lows. So we would not want to trade off of these breakaway gaps. We can potentially expect a rejection, but not to trade off of. So that leads us to the variation breakaway gap, which is very interesting as well. And this is one I have not really mentioned before, and at least not on the YouTube. And on the weekly fair value gap right there that we had with the overlapping high, we can go into the daily. We can see that move higher. Now after that, and I'm sorry, it was on ES actually. Well, this is quite similar at this moment in time, because when we have this fair value gap higher sitting right there, we could argue at that moment that this is simply a breakaway gap right there. So at that moment in time, we would not want to see prices come back to this daily value gap to then continue higher off of that. Let's say this was our entry pattern time frame, and this was, for example, the 4 hour where I would want to take a trade. Then this is exactly one of those examples where I would want to execute on the fair value gap being created itself, where you can also refine your stop loss. Why? It's a breakaway gap. So worst case scenario is that we do come into that breakaway gap right there and then potentially continue higher. Perfect. The probabilities were in our favor overall to avoid that, to not come into that breakaway gap, to already continue higher. All right, if we do come into that, we can still look to continue higher. All right, but if we fully come below that breakaway gap, that's weird price action. So this is a perfect stop loss placement already right there. That is something, if you're not used to that, I want you to first practice that, and I want you to first gather some live data on it. So first try to just cover swing lows in front of the bodies right there potentially, to then eventually try to cover breakaway gaps as well. Now, this is again, same scenario where you would go into the 4 hour and even potentially into the 1 hour if you do not have a fair value gap sitting right there, because this is also sitting right there, a breakaway gap. Why is that a breakaway gap? That is a variation breakaway gap. So I hope you're still sticking with me. It fits into the advanced enrollment perfectly, right? Because it's quite advanced and it's quite potentially difficult to grasp, and I can fully understand that as well. This was a classic breakaway gap. This is a variation breakaway gap. A variation breakaway gap is a breakaway gap that looks like a fair value gap. So it does not meet the requirement of, or it meets the requirement of closing below the expansion phase candle high, which that one right there does, right? It closes below the expansion phase candle high, but still doesn't trade into the fair value gap. That is very interesting. This is where we need to go over when we have a classic fair value gap itself. So not a classic breakaway gap, but when we have a classic fair value gap. And I've written it down in a notion as well. When we have a classic FVG, so a classic fair value gap, just a normal fair value gap, the next candle should not trade away from the fair value gap unless it has been tapped into. So what does that look like? Well, a classic fair value gap is, for example, where we have this fair value gap sitting right there. This is where the next candle, and you can see once the fair value gap has been created right there, the next candle trades towards the fair value gap. That is ideally what you would always want to see when a fair value gap, an actual classic fair value gap, has been created. We trade towards the fair value gap right there, eventually coming into lower fair value gaps to then continue higher. At this moment in time, we create a fair value gap as well. And this is already a very long wick. What is a long wick again? That leads us back to candle signs. And candle signs, a long wick, is fair value gaps on the lower time frame, which means that this already is displacement on the lower time frame going higher. So at that moment in time, ideally for us to trade back into that fair value gap, we would want to see a low close, which just simply eyeballing it and seeing relatively seen to the body, to the overall candle, we can see that this is not a low close. It's a very high close if we look at that. If it, just to give a sort of mechanical, which I don't feel like is necessary, but to give you some sort of mechanical rules to that, if we had a candle like this and we draw the Fibonacci on it, then below 75 right there, I would argue is a low close. Now, if we then see this and we have an up candle after that, and we struggle to come back into the fair value gap, why is that? Because that is a variation breakaway gap. Because we already had a long wick right there, we did not come back into that fair value gap, which some people might have seen as a fair value gap, because simply it's too far right there. Now, I want to go over a few more examples because I can understand the variation breakaway gap might be the most difficult to understand. And I want to go over more examples as well. Where on ES, we mentioned in the forecast, and it was beautifully seen as well. And in a lot of forecasts, if you watch them back, actually, you'll see me go over them as well, where this right here is also a variation breakaway gap. And why is that? We are not closing, let me show you, we are not closing above that expansion phase candle high right there. So in first instance, if people are too mechanical and if people are just, and this is also why I don't want to rant too much, I don't want to go off topic too much, but this is also why I mention a lot of times our trading plan is 80% mechanical, 20% intuition and experience. The 20% intuition and experience is where the benefits are, is where the profits are, is where the higher win rate is where the potential is. The mechanical rules is not where the potential is. Even, I would argue, the mechanical rules is where if you have too much mechanical rules, it's going to be detrimental. Because at that moment in time, if we were just mechanical, purely mechanical, we could argue, all right, that is where that is a fair value gap, so we want to trade off of that fair value gap right there only, not do anything else. Where I mentioned in the forecast that this right here is not a fair value gap that I would want to trade off of. It's not a fair value gap where I would want to see price come back into. Same premise, that this is a very long wick, which is already fair value gaps on the lower time frame going higher as well. So at that moment in time, that for me is a variation breakaway gap right there, which is the same thing as a classic breakaway gap. It's another breakaway gap, and you can go into the 4 hour, into the lower time frame, into the 1 hour potentially, to already find fair value gaps higher to then trade off of. Which on the 1 hour, if I am not mistaken, we had beautiful price action right there, continuing higher as well, coming into this fair value gap, coming into that order block, and continuing higher off of that. So this is where I would not expect this daily fair value gap to be traded into. So for me, that is a breakaway gap. So for me, we don't have daily context right there, meaning that I can go into the 4 hour, into the 1 hour to find context to already trade off of right there. Which we also had a beautiful example of on GBP JPY, and let me find it actually. It was today, and I was up for London session because I was very much interested in GBP JPY, and I was still doing some other things, which is not really relevant, but I was still awake and I saw, hey, it's 2 a.m. Oh, that is London session. That's right. I'm in Colombia. All right. That's very late. Not used to that. So I saw a London session begins. Oh, well, might as well take a look at GBP JPY, right? So at this moment in time, I saw that we were moving higher off of this daily fair value gap, like we mentioned, and we had a very easy draw on liquidity. Very easy draw on liquidity in the form of a weekly fair value gap sitting right there. So this weekly fair value gap right there is a very easy draw on liquidity because we're very close to it. So where else are we going to trade towards? We're not magically going lower, right? We are likely going to trade into that weekly value. Perfect. So here on the daily, we didn't really have anything, but on the 4 hour, we had very interesting price action. And on the forecast, I mentioned that and the price action was right here, this candle, this down candle was actually forming at the moment that I created the forecast. And I mentioned I would want to see price make a very easy way or make a very easy path to trade back into the fair value gap, meaning it should not close above this high right there, and it should be an easy close right there to trade back into the fair value gap to then continue higher off of that. Now, at this moment in time, all right, I would still expect right there, I would have a few doubts because I do think this wick is quite long. But I can also see with the volatility of potentially London coming in, I could see that if we want to trade back into that fair value gap, that could still definitely happen. Until this happened right there. And this was not when I was looking at it. I was looking at it around 2 a.m., which then price action was around this right here. Around here. And when this candle was forming, I could already see that we were moving higher just purely based on the 4 hour. And the 4 hour candle was around here. Around, what is it? Around that right there, where I'm going to make it white to make it visually clear to you. It was around there. And at that moment in time, I thought to myself, well, if we wanted to trade back into the fair value gap before we actually want to continue higher, then we should have traded back into the fair value gap in the first instance before we actually wanted to move higher. Because if we have a classic fair value gap like there, that fair value gap, then the next candle should not trade away from the fair value gap unless the fair value gap has already been tapped into, which it hasn't right there. So at that moment in time, my thought process was, all right, we are not going to come back into that 4 hour fair value gap and we are already going to continue higher. Just purely on the variation breakaway gap understanding. Because I understand right there how the candles overall move, where if we have a fair value gap and we have this close drawn liquidity in the form of that, then we don't necessarily always come back into those fair value gaps. Where right there, this is where we can exactly go into the lower time frame, where I went to bed afterwards because I did not want to wait, I just wanted to go to sleep. And then eventually we had a new move higher, which was very clean right there, and that could have been your trade to continue higher as well. Now again, I say that could have been your trade as in that could have been a very clean setup just using the breakaway gap understanding right there, which of course, this is not a rare occurrence. This is going to happen quite often. And I would love for you to practice this, because just having the understanding of fair value gap is one thing. Mastering fair value gaps is going to do you wonders. It's going to be so amazing for you, because you can understand when we want to trade back into fair value gaps, when we don't want to trade back into fair value gaps. It will do a lot for you. It will be amazing for your overall understanding as well. So this is where we also had a variation breakaway gap right there, which is very important to understand. Now, again, I also need you to understand that, for example, we had this breakaway gap sitting right here, which in first instance, mechanically seen, this could have definitely, well, that is mechanically set, that is a breakaway gap. No other way about it. On the 4 hour though, let's see, on the 4 hour, we already did not have a fair value gap higher. On the 1 hour, we had messy price action right there going higher. So would you use these fair value gaps right there, or would you wait for the daily fair value gap? Leads me back to the story of 80% mechanical, 20% intuition and experience. So you can try to be fully mechanical in the beginning, but eventually that experience is going to need to take over as well. Otherwise, you'll make, well, very, very easily avoidable mistakes like that one, where you can easily avoid that by just understanding the overall price action as well. That is what I'm trying to tell you right there. But this also leads you to understand that, for example, this is a fair value gap you would want to trade off of, and that fair value gap right there is not a fair value gap. And you can see the breakaway gaps and the actual fair value gaps right there as well in the actual making, which is very, very interesting. So please feel free to study this. In your notes underneath this video, feel free to also send me a few notes. If you're in the Discord, of course, feel free to send me case studies. And in the Discord, we have a separate question channel of this video and of the whole enrollment. So if you want, of course, then feel free to drop some case studies. And if you do not understand it, then of course, feel free to reach out as well. All right, perfect. Thank you.